That is one of two divorces I have handled. The other was for my daughter, so a little bit different context. Um, my father, and I'll give you an example of what lawyers can help you with, is that my father, I grew up on a farm. He had a trucking company, and the trucking company sustained the farm. And if you've been on a farm, you clearly understand the meaning of sustainable investing. My father was what Janine referred to as a micro lender. And what would happen probably once every quarter is that Bill, who was a neighbor that lived on a small plot of land, would come by to my father's business and said, sir, you know, I'm running a little bad luck here, and I don't have enough to make it to buy groceries for the kids. Can you lend me some money? And so my father would lend him $100. And he would get him to sign a little note. And then I would be there on Saturday afternoon when this would happen. And 3 months later, Bill would come back and say, sir, kids are getting ready to start school. They don't have enough to get supplies. And, you know, I'll pay you back. I know I still owe you some money. Can you lend me some more? And Dad would lend him another $100. And I was sitting there and I said, Dad, you know he's not going to pay you back. Why don't you just give it to him? He said, son, it would embarrass him if I gave it to him. And then, unfortunately, my father died, and under his will, I was his executor and trustee. And Bill came to me and said, Dennis, I need $100. And I said, well, I can't give it to you from the estate. Bill was not a beneficiary. So all the good things that these investments can accomplish, you have to remember that they're still investments. They're still investments. Many times, if you're in a foundation, you may be better off making a grant rather than an investment. And what I would ask you to do is to always step back and look at your constituency. Look at the owners. Look at the beneficiaries. One word that I always tell younger lawyers in our office is read the documents, read the documents, read the documents. If you're investing strictly for return, then it's not important. If a major issue or a major reason of going into the investing is to accomplish social good, make sure you're authorized to do that. This is an area that Steve mentioned earlier in his presentation where the law and society have not necessarily caught up with each other, but it's moving that way. For foundations, 2 weeks ago, the Internal Revenue Service released a notice of proposed rulemaking dealing with program-related investments. And let me explain where foundations have to be careful about that. And the examples that are used is the purchase of stock in a business that will develop a vaccine to prevent a disease that predominantly affects poor individuals in developing countries. So that company that you're investing in is not a beneficiary. It is not within your grant-making authority, but you're making an investment. If that investment goes south, the foundation managers could be charged with a jeopardy investment and an excise tax. Also, when you start totaling up your distributions and your assets, you have to include that. Well, what the Internal Revenue Service has done is issued notice of proposed rulemaking that says if you meet certain criterion, then these investments are not subject to being characterized as a jeopardy investment, nor do they count, and they could be counted as qualifying distributions. I believe there's some material in the back that will give you just a brief summary of that. And if you have any questions, don't hesitate to ask. But I see that my time is up.
So that is the formal part of our introduction presentation. And what we want to do is just open this group up to you to follow up on any of the things that we said in our opening remarks or ask questions of us that you think we might be appropriate people to ask those questions of. So, yes.
Sure. Well, as I mentioned, we brought in an expert, actually Luther Reagan from the Heron Foundation, to come and speak with the board about the mission-related investments that his foundation had made. And so that was like the grand finale, but previously we had given them presentations about how you can do mission-related investing. We investigated the difference between program-related investing and mission-related investing. And program-related investing had a lot of legal restrictions, so it made it harder for the board to swallow, whereas mission-related investing, you didn't have to follow all of the legal, well, you didn't have to get the private letter ruling that is required to make certain program-related investments if they don't meet certain criteria. So we chose to do the mission-related investing route. And it took just, 2 years of repeatedly going over the same information and exposing them at conferences and things like that. So a lot of patience, but it paid off in the end.
It's both. Yeah, we've got a handful of clients that are totally mandate rich around this, and a handful of clients who've expressed some curiosity, and we just open the conversation. No, I've had my own capital. Started off with SRI 15 years ago, and then morphed into ESG, and then morphed into impact 6 years ago when I first heard the concept. I was like, that's the future. So for personally, it was a different journey than for what I represent as a partner in my firm.
That we thought about it, but we thought that there were a couple of issues. It was so idiosyncratic that it was an experiment. So we looked at that. We did create a second fund in the for-profit activity, which actually has some foundations, some European foundations, investing in it, and it has about $45 million committed. It's most of the way invested now. So it was, let's find out, let's put at risk our own money first, then let's build upon that. And the second fund, actually, what we found in the financial transaction activity is one of the keys was applying existing technology. So you're not creating new technology, but existing technology in the developing world, which drives down the cost of transaction, and it becomes, rupees. And they focused in India. So they're looking at India for a variety, whether it's health appliances coming over the cell phone, whether it's money transfer using the cell phone. That's what they're focused on. So it's closed now, but it is open, and we're just trying to prove to ourselves that it works. And now I think there are 4 investors in that. So I don't know what the next fund is, but be happy to introduce you to those folks.
You get more protection by investing in the fund. I mean, if you got a large infrastructure where you can do your own due diligence, then investing in individuals will work and will be more direct and be less expensive. But you're taking greater risk by putting your eggs in one basket. And most organizations and families I work with do not have the infrastructure to do the due diligence and do the follow-up and the valuation.
I'll just piggyback on that and say that what we see in our client base of 1,100 foundations is certainly not a wave of this, but increasingly foundations connecting with each other to share information, experiences, opportunities around the individual investment opportunity. And so even though they don't have the complex infrastructure in place that an institution would tend to want, the fact that they're able to share information and experience helps them focus more on the individual side of that than on the institutional side of that. So I think that's a evolutionary growth in the private foundation community, where people who are doing this work are starting to network with each other to share that information. Yes.
So, I mean, I think it was maybe a week or two ago, JP Morgan announced they've created an impact investing platform. It's kind of curious to ask the panel in general, what does the world look like, 5 years from now, within this space? And like to also just get comments about, what's the rationale or the motivation of JP Morgan and other large groups announcing some of these initiatives?
Let me just say, from a financial institution perspective, I would say over the last 20 years, financial institutions in this country have responded primarily to the demands, the needs of their high net worth and ultra high net worth private clients. And so to the extent that there is a persistent request for product, service, advice from the top market segment, then large financial institutions will over time respond. I think the issue is it profitable? Can it be supported on the infrastructure that exists within that firm? So if it's a bank or a brokerage firm or a broker-dealer, do they have the infrastructure to support the evolution of the product or service? To build a new platform is an expensive proposition, and most companies won't do that or can't. And then the last thing I would say is the future is if high net worth and ultra high net worth.
King, you're right. The challenge is it's not really scalable, and the institutions are looking for scale. Yeah. And if you're building a bespoke portfolio for an impact investor, how does that roll out to the next guy? I mean, one person wants to express a theme of providing clean water in developed nations, and the next person wants to focus on sustainable agriculture. The next person wants, it's like that. When you start rolling that out, it's really difficult to do it. It's time consuming. It's not profitable. I can tell you that internally we debate that all the time, and I think it gets really complicated because frequently we're dealing with clients who have foundations and they want sort of discount rates, right? They want us to do it for 40 basis points. So we're looking at that and saying, okay, this is a hypothetically $20 million portfolio. Let's say you're going to carve out $10 million for private equity, so you got a $2 million tranche there, and you're going to roll that out over 5 years. Okay, so maybe you're putting $400,000 a year into it for your private equity allocation. Okay, so maybe that's 60. I can do math fast enough, but $10,000, $40,000 investments. It's like, how can you possibly harness the resources necessary to do that responsibly as an individual firm? It's really, really difficult. When I think about JP Morgan doing it, they're trying to productize it. And I know Paul Hatch pretty well, and I was at the meeting where he announced the same initiative that Morgan Stanley's doing, right? It's their impact platform, and he's sitting there talking about it, and he's talking about our impact strategy, and eventually says it's basically a negatively screened long-only equity portfolio. Okay, fair enough. That absolutely there's a role for that in a broad portfolio, but I think there's a lot of debate around what the impact of a non-activist, negatively screened, long-only unhedged equity portfolio is. And I think for the big firms, that's where a lot of their marketing is going to go initially. Hey, buddy, here, carve it out as an asset class, 5% of your portfolio. Here's our product. It's our impact product. You feel good, right? We're responding to your needs, to King's point. But I'm really cynical about them. I spent 14 years at Smith Barney, and I'm cynical. Sorry.
I'll give you in a second. I just want to pick up on one thing. I think the marketplace, the financial markets. The financial market is the great commoditizer. Its function over time is to commoditize financial solutions, and over time to drive the cost of those solutions down to a scalable level. And I think there's an inherent conflict between that dynamic in the traditional financial markets and some of the things that this panel have identified as the objectives of impact investing or value-centric investing. So I think there's a tension at work that I think will be interesting to see 5 years from now. But I think the financial market tends to neutralize